Okay, thanks everyone for attending this workshop. We're going to first give you a very brief introduction who we are and what we're doing, and then we have brought some slides for you. However, we would rather have a more discussion and Q&A talk with you guys. So we're going to guide you through a little legal and tax minesweeping. We'll also shed some light on special aspects of latest developments in M&A and exit transactions. And then by the end of the show, you should be able to ask some questions that really come from your past and upcoming experiences. Okay, so now we have a clicker. Okay, some more talking. Slides are not ready yet. We start with the introduction.
Yeah, okay, presentation. So, okay, what are we talking about here today? So, thanks for staying here in the room. As I said, it's getting boring right now. So, actually, it's a great pleasure and honor to be invited here. Besides all this AI stuff, we are just a tax advisor and a lawyer. Nothing with AI, but what we do is we help, let's say, emerging companies in the end to be sold. So we are so we might think a lawyer and say we are on the large corporate side. Within the last 10 years, we have helped founders to sell their businesses. And in order to have it a little bit less boring, we thought to discuss some major issues that always pop up and that can be easily avoided. So that's why we wanted to talk about Exit-Readiness and the entire M&A process, which is not too hard, as I said, but it's nothing technical. So we skip the so that's something. All we do, all these things have to do something in the end. With the exit process. These are all things which have to be dealt with. So it looked very complicated, but then in the end, things when it really comes to an exit, when it really comes to discussions with a potential investor, when you want to sell a business, or if you are an investor and you want to acquire a business, from the last, I would say, 10 years working with startups, and actually in the last 3 years we have sold everything to large startups from 3 years old to 10 years old to things to Amazon or to Microsoft, etc. And the questions are always the same. So if you want so, just to, let's say, open up a little bit, we just thought it might be somehow interesting to tell some war stories until we come to, let's say, more technical questions. So what happens? The most important thing, and why do we call it minesweeping or minefield? So our experience when you start a business, and I've seen also some guys from Founder Institute or so when you start a business, you think about a lot of things, but probably not about talking to a lawyer or maybe to a tax advisor. A tax advisor might be a little bit more mandatory because the tax authority will ring at your door if you don't do this. But lawyer costs money, etc. And I fully understand that's a little bit cumbersome. So a lot of things happen in the beginning, and you will not recognize it. You will not even see it for 2, 3, 4 years. But then you want to sell your business, or even maybe in a financing route, but when you want to sell a business, it comes to something which is called due diligence. So you probably have heard about this. So what does it mean? Investor comes and X-rays your company. So they want to see everything, every document, from the beginning on, and then things suddenly pop up. So and things which you might have forgotten about. Our experience is the most expensive mistakes are made in the beginning, and are when you enter, and when you're very excited to enter into this M&A process. Investors are interested in your company, and And what we also experience, an exit is not always something which calls for large amounts of money. In the current economic environment, what we also see is a fire sale is also a successful exit, because you avoid insolvency. But the problems and the technical things are still the same. Maybe we take the next one, because So what happens? So, for example, just to give you an example, we had a startup, a software startup, where a large US tech company was very interested in, and they made a technical due diligence on the code. So what did they see? They went into every single log file and examining who did produce this line of code. And then they checked whether there was a so-called IP transfer agreement between this guy, or maybe most of them were guys, and the company. And although they were very well organized, so they had over the time they had 25 employees, freelancers, whatever, and they had 24 IP transfer agreements. So a piece of paper where you say, okay, I work for the startup and I transfer all the IP I'm generating to this company. One was missing. However, if you are a startup with five employees, somewhere in Kreuzberg, probably no one will sue you if you are just doing your business. However, if you suddenly are owned by a large US tech company, things might be different. And in particular, this US tech company will not run the risk that someone comes around the corner after 2 years, once they have integrated the acquired software into their business, for example, for scaling, how does it called, server farms, for example. So you see the risk. And so they said, okay, before we close this transaction, you have to provide the IP transfer agreement for this missing person. Sounds easy. Problem was, in our case, this guy, after having stopped working for this company, left Germany for Brazil. So between the signing of the transaction and the closing, so when the money comes in, our founders, 2 of them, had to travel to Brazil, somewhere deep in the country, meet this guy who was very happy. It's a long time that we haven't seen, etc. They spent 2 days, 3 days with him. And then they said, could you please sign this? And this was then not the standard IP transfer agreement from a startup, which you can download somewhere or ask a lawyer, that was then the US company standard, which was 20 pages. So a little bit more. He was happy to see them. However, he was not completely stupid. So he said, okay, thank you I will sign this, but what's in for me? So they had to pay a little something, and then he signed it, they went back, transaction was closed. So everything went well. So now imagine the guy would have moved to Brazil because they had fired him. Yeah? And then he wouldn't have talked to them even so. And the sum for signing it would have been probably higher if he would have signed it at all. So, and this, in our case, would have been a complete deal breaker. What has this to do with our, let's say, workshop today? These are things which are discovered in a due diligence prior to such a transaction, and which can be avoided if you do this due diligence that the investor does, in any case, on your own before you enter into this transaction process. So, to tidy up a little bit, let's say, your company. And this is something, if you are a tech company, this IP transfer thing is one of the most crucial parts, and in nearly every transaction when we sell something, there's somewhere something like this. So it's just to get an idea how important can it be that from the beginning on you pay attention on this tiny little detail, because in the end it can be can have tremendous consequences. Yeah, another thing was same transaction, by the way, non-disclosure agreements. So sometimes you have to earn money, so you develop a certain software, but however, in the meantime, just developing a business might not, let's say, pay your bills, and investors might not pay for everything. So they, no, that was another thing. That was they were developing, let's say, some sort of computer game, but they also developed software for professional education. Let's say, in our case, for a hospital. And by doing this, they used their, let's say, their gaming software and put this into an exclusive license for a hospital education software. Meaning exclusive license means the entire software they were developing for their gaming was not usable anymore for their business model. So, and by not paying attention to this, let's say, standard license agreement provided by the hospital, and because lawyers are too expensive, they didn't ask, they killed the entire business. Just as an example. And last example, and then we come to the even more boring tax things. We had, so sometimes you enter into some sort of, when you talk to clients or to customers, they will have you to, they want you to sign non-disclosure agreements, NDAs. And NDAs, that are 3 pages, 2 pages, whatever, and no one likes them. And always, so even large companies say, we want you that you develop something for us, but we have to provide you some confidential information, so please sign this NDA. This is standard NDA we always use. Which comes from our legal department. Please don't alter anything, because otherwise it's taking, and then you sign it just because you want to earn money. In our case, we wanted to actually sell also a software company, and all these NDAs they had 80 NDAs, and 40 of them had no limit, no time limit, so with an undetermined period of duration. So sounds boring. However, so if you are a startup, let's say from Kreuzberg, 5 employees, after 5 years, no one cares anymore about your NDA. However, if then this startup is acquired by someone like, let's call them Microsoft or Tesla or whatever, things are getting interesting. And like Microsoft or Tesla, they don't even know what kind of confidentiality obligation they are buying. So what do they want? They want to put a time limit on these NDAs. So on our transaction, and with a two-digit million purchase price, they said, for all these NDAs with an undetermined period of duration, please go to your former customers and enter into agreements that this ends. So we had a closing period of approximately 9 months, where they had to travel to all these customers, not having seen them for years in certain cases, and asking them again, could you please sign this? So some of them just signed. Some of them, like the guy in Brazil, said, okay, yeah, we can do this, but what's in for me? So it became very expensive. Simple thing, you just put a time limit like 3 years, 2 years, 5 years, whatever, and then the issue is solved. However, if you don't do it at all, in the exit process, it can be just a killer for the entire transaction, which means also that your investors might get very, very angry, because they actually invested in you because they want to. So if you talk to VCs, they want to sell the company. So that's these are some of these examples. And of course, we could continue the entire day, but we have still some other points.
Yeah, maybe go to the next slide and just have the headlines. Of course, the same thing that Stefan just described from a legal perspective is happening all the time from a tax perspective. Of course, you are obliged to file monthly VAT returns from the very beginning of your enterprise, but nevertheless, there's still so much going on besides this and that will pop up in the end. And I have like 2 examples where especially the minefield case, the minefield example, the metaphor is working quite well, because in the very beginning you almost like to place those mines around you in order to help you, to support you, and then in the end you have to clean them up, and this cleaning up, this minesweeping really might take time and cost some money. So first of all, there's a word in English, and it's freelancer. And usually I would put here, what the fuck, but I don't, because KPMG doesn't like the F word. From a German tax perspective, there is no such thing as a freelancer, because the only people in German personal income tax that earn income from freelancing are like doctors, tax advisors, lawyers, but someone who is providing professional coding or doing business advice or whatsoever, they're not freelancers. So there is no such thing as a freelancer. And a lot of startups at the beginning, and of course it's kind of hard to have all the people on board and employ them and pay wages to them on a monthly basis. And so they use these so-called freelancers. And this is really always getting some troublesome end when you enter the DD process, because the investor, they know that for years after this freelancer has provided services for the company, for years after this provision of services, they might be liable for any wage tax that would have been applicable to the payments to this special freelancer, service provider, whatever we call them. So whenever you have the time to clean up your contracts, to have a look at the contracts that you have been putting in place with people that provided services for you, have a look at, did they only work for you? Do you know if there were any other clients at all? Do you know what they did anyway? And especially, how was the setup in your contract? Because it's not only the question whether they are providing services to other third parties, but it's also, did they have an email account from your company? Did they have an office where they had a key for in your place? Were you entitled to tell them the hours when they were supposed to work? And all this stuff put together, this is really triggering the switch between having a service provider or having an employee in the end. And so not in order to be in the situation to have all these contracts and maybe even some facts that are just unchangeable in the period of time, just to not have this in your hands in the end. Have a look at stuff like that once in a while, and if there is a chance to correct it, do it. And if you see that there has been trouble in the past, at least find someone supporting you to put new contracts, new regulations in place that protect you in the future.
But pay attention. Yeah, if you tidy up your business and you say, okay, your business is now running, you can afford to employ them, not having only freelancers. Don't say to an investor, in particular from the other side, we made all our freelancers our employees without changing anything, because that's the best argument to say that you have a tax risk.
Yeah, they never
change. So the trick is change something in the job description.
Yeah.
But this was free, free advice.
That's good point. Good point. The next thing is, today everybody wants to work from anywhere. People want to work from Mallorca, from Ibiza, from Brazil, and they work for your enterprise, for your company, which is based here in Germany, and you're supposed to be a wage taxpayer to the German tax system. So, however, whenever you have people that are really doing crucial things for you, have in mind that they might generate, with what they do abroad, they might generate a permanent establishment for your company abroad. And then you end up also in a situation where you have to give the exit investor or any later stage investor, you have to give them guarantees, you have to give them, they take a guarantee away from the exit proceeds, just to make sure that in case something like that and a double taxation situation pops up, they don't have to take the money from the company they just acquired. They're going to take it away from your exit proceeds. The next thing, and this is my last example, because then we should have some more time for M&A stuff and some questions from your side. Sometimes Stefan and I, we are engaged to provide ESOP services together, and I personally think this is the best setup. Why? Because there's so many legal firms that are providing beautifully sophisticated virtual and non-virtual employee stock option plans. And they're all amazing. I've seen several of them. But the more sophisticated and the more amazing they get, if you have this mid-size Swiss AG acquiring you for 150 million, and they are then in the end liable for the mechanisms, for the payments, for the payment schedule, for everything that is around this virtual employee stock option plan, might take you some 3-4 weeks to figure it out in the sale process, how this actually works, because, and this is the mind-sweeping example, by the point in time you put ESOPs in place, you need them in order to protect you that other people hire the guys that you just onboarded. And a few years later, you need to move away those mines, you need to sweep them, because otherwise nobody's going to really be interested in buying your entity, because there's so many liabilities from these programs in the entity, nobody really understands and nobody really knows how they work like. And this is not only from a legal perspective, but especially from a payment schedule and from an accounting perspective. And this has to be taken care of in the exit procedure as well. So, but these have been the examples, and I think, Stefan, now we should go to the M&A trends that we've seen in the last couple of months. Yeah, and then we picked up. Okay, first of all, here we have a typical example of a growth funding period, of a growth funding timeline. So at the bottom, you basically see the valuation in time. And then, of course, you see the different classes and allocations of shares that are being offered to investors along this period of time. And then the interesting thing is, and this is, I'm going to pass this on to Stefan, the interesting thing is that you are looking here at the second funding round, and you have Pref A shares, Pref B shares, and you have the ordinary shares. And then you enter into exit phase, and already this entering into exit phase makes a difference whether you are going into a classic M&A exit, selling all the shares to one investor, or maybe going into an IPO, into a conversion, because in the IPO situation, some shares just remain with everyone else, because there's just basically new shares that are being offered to public in the IPO process. And so what we, and this is what Stefan said at the beginning regarding the fire sale, and he's going to give you some more details right now, this is really important for you, because you guys, you founders, you will be the ones having the ordinary shares. And this category of ordinary shares in a fire sale might end up with a totally different final scenario than what you would have expected. And this is because of the next slide. And here it goes to Stefan.
That's why I said the war stories were interesting. Now it's the boring part. What does it mean? So I go back here. So this part is the ideal world. So in the beginning, founders have ordinary shares. You have 100% of the company, it's worth 1 million, you own 1 million. So now you get preference shares. So investor comes, what does it mean? Investor says, I give you whatever, I don't know, 2 million, I get 30%. So from a lawyer's perspective, that means 30% for 2 million, company is roughly worth 6 million something. Okay, however, you still have some shares. Then investor gets this next round, you have preference shares, another waterfall set comes on top. So in an M&A case, why is this different? In the IPO case, all these different classes of shares are, let's say, converted into normal shares. So everything should be the same. However, we see on the next slide how this is translated into value. But this would be the world when, let's say, value is growing, shares are growing, and the exit proceeds are sufficient to pay everybody. So now we come to the, let's say, more critical thing. Sorry for being so small, so we wanted to enlarge this, but as I said, fire sales are currently something we are working a lot of, so I had not too much time to spend on this slide. However, the most important thing here, this is the cap table. So you have 20% ordinary shares, and here 55% preferred shares. Which?
It's the other way around.
The other way around.
Sorry.
Okay, sorry. Yeah. So, however, so this is okay. This is the growing value. So if you say, for example, new preferred shares were for an investment of an investor who, in the last round, invested 10 million into a company, let's say, independently from the valuation. Let's say he received, what did we say, 10 million for this? Yeah. Huh? Florian? Yeah, that's it. So he got 25% for 10 million, mean it's a 40 million valuation. Sounds cool. However, now things are not, business is difficult with the times and COVID, etc. We all know this. And you sell this company for 10 million. Here, he has only 25% of the shares, but gets all of the proceeds. Second round, old preferred shares, they had something, here this is the other part, also 25%. The other, so you sell it, they also invested 10 million. So first 10 million go to these ones. Second part of the 10 million, if you sell it for 20, goes to these ones. Again, ordinary shares means founders plus management compensation, meaning virtual share programs, etc. Nothing remains. So it ends here. Even if you have still, that's, I don't know, 30% of the company, you don't get anything from the proceeds. So, and this is the meaning in a nutshell or the consequence of liquidation preferences. And you see this very often in every term sheet. You see this. You get a liquidation preferences, but however there are also differences in these liquidation preferences, and that's where you should. Yeah, someone has to pay attention on it. Because otherwise, everything goes to these ones. And however, this, from our perspective, it seems somehow normal that you think. But I had just last week that even a venture capital fund who had the new preferred shares on the first round, and they were surprised that suddenly the founders did not continue to work on the transaction, because once they had calculated this thing, they said, okay, now because such a transaction is a lot of work, yeah? It keeps you busy, lawyers keep you busy, tax advisors keep you busy, everyone has questions, 100 people are running around. But you're pretty sure the only one who receives something will be your investor in that kind of transaction.
So basically, for every one of you that has liquidation preferences on shares, it would be possible to have this graph built for you, because the bottom line is the amount of money that is flowing in with the exit, and then the more it becomes, it varies in the provision upon the special shares. And on the right-hand side, we try to display that the 25% shareholder with the new preference shares receives 55% of the exit proceeds, even though he never had any one more share than 25%. And so you really need to be aware of those mechanisms. And this is also something where you're not just only capable to read the contractual agreement and understand logically what the liquidation preference is about. You need to put it together and have basically someone to calculate those scenarios for you, because otherwise you will never know by which exit proceed you enter. You walk away with what kind of price for yourself. Last but not least, before we go into the open mic session, if anyone wants to raise a question, last but not least, let's take the next one. Last but not least, any one of you who is a founder and has not yet established their own holding entity, you should be aware that from an overall perspective, at the end of all days, taxation in Germany is basically equal and fair, and everyone pays approximately, let's say, 27, 28% in the end of time on every euro you gain from a sale of shares. But there's the difference. If you have this holdco in between you and your operating entity and you're then selling the shares, in a first level of taxation, solely 1.8% tax is being required in the point of selling, point in time when you sell the shares. And so therefore your leverage, your ability to reinvest, if you're like, I don't know, 32 selling your first startup, what are you going to do? Spend the millions sailing the Mediterranean? You could do so, but if you really want to reinvest, you should have the second model in place, the right-hand side model in place. And yes, a lot of people will tell you if you didn't do that at the very beginning, it's kind of hard to set it up afterwards. It is, but it's possible. And so this is also stuff you can take care of at a point in time where your business is running a little more smoothly and you have people around you that support you. And then you're the founder and you can think about something like that. Okay.
Just to, are there any questions on this? So otherwise I can, so let's say, because this was a tax guy who explains it, to put it simple. In this case, you have a startup company, you own it, you get 100 purchase price, you immediately have to tax 28. So if you want to reinvest, you can only reinvest 72. So quite simple. However, as he said, if you want to spend it into Ferraris, Porsches, whatever, so what guys like us would do, so you don't need such a holdco, okay? However, if you say, I don't really know if I really want to spend it in Porsche, Ferrari or whatever, or maybe I would reinvest into other business ideas, it is taxed on the holdco level at 1.5. So you receive 98. You receive 98 out of 100 here. If then it's in here and you say, okay, I don't want to reinvest, I spend it in the Porsche, you take it out, so it costs you these 2%. However, if you want to reinvest it into other startups, you can reinvest 98 instead of 72. So that makes the difference. And it makes also sense if you say what we see a lot of, in many cases in the last times, in particular when it comes from US investors, they don't always pay in cash. So they pay you 100, but not in cash, but in shares. And these shares, in order to, let's say, save their stock price, etc., you have to keep them. Meaning, they pay you 100 in shares, you would have to pay taxes, 2% in cash to the German tax office. So we call it that dry income. Yeah, this is very important.
And in the first case, if you would receive the shares of a value in 100, you would receive no money at all and still would be taxed with 27, 28 that you have to pay from your personal fortune, from a bank loan, wherever from, because they're not going to let you go off without having paid those 27, 28 on the 100 that you received in shares. So that's why it might make sense to have this holding company. However, if you go out now and run and say, okay, I want to have a holding company, you have to be aware it's a company, so you have to do all these boring things like accounting, tax filings, publication, so it costs money. And actually, we had some founders who said, well, you told me to set up this holding company, now I have set up this my startup, and since 6 years, we haven't sold anything. Yeah, it's running, it's okay, we are alive, we are not dying, everything is fine, but I still have this fucking holding company, which costs me every year 1,000 euros, and which is completely useless. So that's why it's a luxury problem in the beginning. First of all, and it only makes sense if you say, I want to reinvest. It might be a little bit, let's say, over-ambitious to say, I want to do a share-for-share deal in 6 years. So that might be a little bit over-engineered. However, it still makes sense. And if you say, okay, I started as a single shareholder without the holding company because all this is way too complicated, etc., you can still change this. However, you have to keep in mind, it makes sense if you then keep your company for 7 more years, just to go into a little bit more details. However, if you just want to set this up just before the exit, because here it turns out
shit, I have to pay 3 million in taxes, and here I would just pay 100,000. If it's just before the exit, it doesn't work anymore. Yeah. Yeah. But however, we see this very often, and it would make sense. And another thing, even if you are 2 or 3 founders, please do not set this holding company up with 3 founders together. Yeah, because so imagine you are 3 founders, and after having had your startup for 7 years, so which means you stay together, you know these people very well, and then you sell it after 7 years. So now the normal investor says, okay, after 7 years, I buy your company. You will get only the entire purchase price if you work still, let's say, another 2-3 years for me. So you still have to stay with this company in order to get the entire purchase price. After 9 years, you can't see your co-founders anymore. Yeah? In particular, in the first, frankly, I've seen this, so that's why I'm telling this. Yeah. So one of these 3 says, oh, I want to continue in that company, and I want to reinvest into another tech company. The other one says, no, I'm done. Thank you very much. I go to Greece, I buy a boat and a Ferrari, and everything is fine. And the third one says, okay, yeah, no boat, Ferrari, yes, but so. Then you have a conflict here because you would have to spend all the money. So in the beginning, it's clear you might be friends and everything works well. After such a long time, everyone has its own perspective. Someone has family, the other one, no family, drug addicted, whatever. Or even going back to university, I don't know, becoming a lawyer. Unlikely, but however. So saying, and in particular, it makes things in these companies with vesting mechanisms even more complicated if you are 3 or 2 founders in such a holding company. So in this case, as we are here, instead of don't do this. Yeah? If you want to do a holding company, do this alone. Even if you found your company with your girlfriend, boyfriend, or wife, do it alone. Period. No comment anymore. So.
Okay, so I think we have actually some 5 minutes left. Anyone wants to raise a question? Otherwise, we just tell you another story. We have some more stories. Okay, there's a question and another one. Oh, no. Can we put the mic on?
Take this one.
You were speaking about the freelance problem, right? So, of hiring and so on, which is very well known. Is employer of record companies really solving this problem? This is my question.
Okay, we would basically have to split it in a legal and a tax perspective, but I think the tax perspective is the more interesting one. The employer of record solution from a German wage tax perspective is not a solution. This is quite simple. For a few months, yes, for a certain period of time, but from an overall perspective, if you would have everyone working for you under this employer of record, this would not work for German purposes because, as I said earlier on, the German view is not on the pure contractual agreement, it's basically on what is happening in real life. If you tell all those people when to come to work, how long they should work, if they have to apply for a vacation with you being their boss, if you do a lot of other things that just employer would do to their employees, then they are qualified as your employees, no matter who is the party they're having the employment contract with.
Thank you, but employer of record also allows you to hire directly in the local country. So you pay actually all the wages and all the social securities and so on. So why in this case is not solving the problem?
It depends. I mean, if all those people are working in that respective country and not in Germany, then this might be something that works. However, then there is, from my experience, the labor law perspective, because in the end, then you are fair and okay with the social security contributions and the wage tax in the respective country. But if you still have control over those people, you might still be their employer.
And you have a problem with the permanent establishment.
Yeah,
so it's another tax risk. So it works. So what you can, so don't publish it. So you can do it for 2 or 3 months in the beginning. You go to a country, you don't know how to solve all these issues with setting up a company. You can do this. But then you have to transfer it. And also, if you have too many people in this employer of record thing, then you develop your own, let's say you develop already a business, and then to transfer this to your company is, even from a tax perspective, an even more complicated thing. Legally, it's easy, but you create other problems. Okay.
Good. Yeah, one more question relevant to ESOPs, right? So you mentioned about ESOP program and so on. So there is no real virtual shares here in Germany, right? So it's all contractual. So what is your suggestion? I mean, like, not to give to employees any virtual shares. So because you describe it as a
no, it's
mine, right? So what is the outcome?
Sorry, give your employees virtual shares that are based on a contractual basis. But the only thing that we're telling you is cross-check after you have implemented the legal program, what is the economic, the balance sheet, the wage tax, the payment schedule consequence by the time you have the exit event. So yes, you should have one of these programs, but in the best case scenario, by setting it up, you do not only have a lawyer, but you also have a tax accountant, and they both together tell you from the very beginning, if you do it like this, in 5 years, in the end, it goes out like that. So here was another question.
Stay organized. So that's
just one question about your freelance issue. If the freelancer is another country, like suppose Middle East, what would be the case for the company then?
Have a permanent establishment.
Yeah, it's the permanent establishment topic is always a matter of responsibility and how much they are in charge in this respective country. So if they remain there for all times, the German entity might become a wage tax payer and social security contributions payer in that country. So basically, this is, I tell a story from a US perspective. If you are a German GmbH and you have 20 people running around in the US working for you, and they're sending you invoices, and they don't pay taxes in the US, and you don't also. And there will be this one day, and you're the managing director of your entity, and you travel to the US, they just click you by entering the US, and then they're not going to let you go any earlier before you have paid your dues. So this is really, and I mean, of course, this is a highly sophisticated legal system in the US. I don't know how it would be in Palestine or in Egypt, I don't know, but still, if you end up having had wage tax or social contributions liabilities in that countries, it could become kind of hard to travel there, do business there.
From an M&A perspective, it's a problem for the valuation. Thank you for your attention. We are now running out of time, and if you have any questions, Florian and I are still.
Yeah, we're still available. So. Thank you, guys.